Welcome to episode 9 of Kontrarian Korner. I'm Ben Kelleran. Today we have Andy from Finding Value Finance on. He's a guy I've been following for a while now. He has some great daily YouTube updates as far as what's going on in commodities markets, what's going on with the big picture, what's going on with some of the meme stock crazy see, what's going on in real estate, but really good daily updates. So Andy, thanks for coming on.
Yeah, thank you, Ben, for having me on here. Really appreciate it and inviting me. So thank you for having me on.
Yeah, if you could start and give the viewers a quick background intro on who you are, how you ended up writing, talking about investments, starting the YouTube, all that, that'd be awesome.
Yeah, I can jump into that. So I went through training like high school and then into college. My training is engineering as a background. Manufacturing engineering, to be more specific. I graduated, went into the working world as an engineer, and I said, wow, these guys don't make all that much money. So what I tried to do was figure out ways to make money outside of my job. So investing was one of the things I became obsessed with starting, I'd say, about 22, 23, 24 years old. Started getting into investing. I didn't know all that much about it and just kept progressing over all these years of trying to figure out what works, what doesn't work, and trying to find better returns over all that time. I wasn't very successful in the beginning. I was much like everyone else, I would say, trying to figure out how to get from basically not knowing anything about investing to becoming someone who gets returns that are equivalent to someone like Buffett or something like that. So I spent a lot of time. I was on and off trying to learn investing in my 20s and even in my 30s as I was working quite a bit. And then eventually, ended up getting married in my 30s and having kids and all that stuff. So I was on and off trying to learn about this stuff, but I've really been focusing on it. I would say about 2018 and onward, I really, really dove into it, head over heels in this stuff, and really did a lot of deep dive research, figured out the real estate cycle and how money flows between assets. I dove into a lot of the ratios that I used earlier on. Before that, I incorporated that into even how I look at the market just in general. And then I always had technical analysis, and I've adopted a lot more, I'll say, a lot more of Buffett and Lynch into my investment strategy and approach than I had before. So I was more of just a short-term trader, more of a hold for like shorter periods of time with some of my money. Other money I would hold for longer periods of time. And I'm pretty much all in on the Lynch and Buffett approach, longer-term investing. I don't do the short-term stuff anymore at all. But it does help with my short-term entry points. I created the YouTube channel. I was at work, and it was in 2020. The March crash occurred, and someone made a comment about the housing market just crashing. And I was like, it's not going to crash. It's going to go way up. If they lower rates like they say they're going to lower rates, I mean, we're going to sail. So I was listening to Graham, Stephen, Meet Kevin. These guys were all calling for a crash. Some of the younger guys that were looking at buying homes, they were like, oh, I'm going to wait. I'm like, no, it's not a good time to wait. I would go in. And then they kept pestering me about these guys who kept saying a crash was coming. And I just got fed up. And I said, you know what? I'm going to start my own freaking YouTube channel and give my opinions out there, because I couldn't handle it anymore with everyone telling me all this information that I thought was incorrect. So that's where the YouTube channel basically was born, was from frustration of others telling a bunch of information that I thought was not to be correct or true. So I wanted to give my opinions out there, and that's exactly what I did. And I also aligned it pretty well with what I thought was a big commodity bull market that's coming. I was also talking to them about a commodity bull market. We bought the bottom of a lot of different companies in 2020, people at work and myself. And then they were like, yeah, start a YouTube channel and get it going. And I was like, all right. So that's where the YouTube channel came from, was from frustration, and then from a commodity bull market, which I thought was a good idea to start at the bottom of the commodity bull market. I started the channel in August of 2020. And don't go back and look at my earlier videos. They're pretty bad.
Yeah, it's what you're saying there about the frustration, the thumbnails with buildings on fire and the red arrows down. That's always good for clickbait, but not so good for being accurate or over the target on some of these things. But to go into what you're saying there about a commodities bull market, I think at least what I've seen, I think that lines up. It's obviously going to be a bumpy ride, but I think that lines up with where we're headed over the next, call it 5, 10, 15 years. It's been an interesting couple of days, maybe a little bit of a signs of a rotation trade starting, but might be good to start with oil and some of the things you're seeing there as far as the long-term future and where we might be headed for maybe the next year. And then longer term, I think we are going a lot higher as far as oil price, and that's obviously going to be good for a lot of the equities. So I don't know if you want to share screens or do anything like that, but we can I'll just hand it over to you and you can drive from here. So
yeah, I can describe a lot of it. So you've got the demand side, you've got the supply side, and then you've got a bunch of other stuff of money rotation kind of all about. So I'll start with the supply side and then we can work our way forward from there. Supply side, I think oil is running on fumes on a lot of the conventional oil. So these big oil areas that we have found throughout the world, big reserves, they are depleting, and some areas have already rolled over and are declining. Fields like Cantarell in Mexico, fields in Kuwait, fields in Saudi Arabia, which is questionable, like Guar. You start taking these huge reserves. You look at those fields, the conventional fields, and they do look toppy, or they have already rolled over. And there's a lot of fields that when you aggregate those fields all up, that we could potentially be, have already peaked in conventional oil. And what really has taken the place of conventional oil has been unconventional oil, which is the shale oil in the United States. That's been the big driver in growth in the world oil production the past, I'd say, decade. And a lot of people are speculating that we are very close to peaking in unconventional oil in the United States, which in my opinion is probably pretty close. When looking at the data, I could be convinced. But I could also be convinced that there still could be a little bit further runway ahead. If oil prices were to go up, we could actually see maybe what the field can do. So I'm a cautiously optimistic person on world oil production. So the supply side, I think, is flattish. Maybe we go up a little bit more around the world. And that leads us into the demand. So it's like, okay, how does demand stack up against this supply? Demand, the way that I view it, a lot of people just view it as, you know, the demand for oil. I view the demand for oil as money being printed and put into the world. So credit expansion and money supply growth is oil demand. So when credit expands, when we look backwards and the debt levels weren't as high as we are today, credit expansion from the real estate cycle is what basically demands or puts demand on oil. Every time we had a supply constriction, when that credit growth comes, we've seen big inflation. So 1970, we peaked in the United States for conventional oil, and it was a monetary credit growth expansion phase of real estate. So that they collided in the 70s. Then we had another collision of world oil production kind of peaking out of conventional in 2000s, with credit expansion in the United States being a big driver of oil demand. Same with China, combination of both of those things. And then I think what's occurring now is the world is starting to run into what I think is just conventional, unconventional. We're going to get tight in oil supply, specifically of cheap oil. So I think we're going to get tight on the supply side. And at the same time, all these countries are running deficits, fiscal deficits. So that's from the government side. And we're in an expansion phase of real estate in America, which is also going to be credit driven or credit growth. So you've got the growth of the fiscal side and the credit side kind of growing. And that's paired up with worldwide oil supply that I don't think is going to grow as fast as credit. So that's going to be inflationary for a period of time going forward. And that inflation is going to continue to put pressure on oil supply until the supply goes up. Now, if the supply doesn't go up, that's when things get really interesting. Obviously, prices are going to go way up. That's going to have to kill demand. And then we could potentially lead ourselves into problems with currencies and bond markets because those are all predicated off of future growth, which is really just future growth of oil. And if you have problems in the credit markets, you're going to see pressures built, in my opinion, in gold and silver, much like the 1970s. So my viewpoint is energy is in a very good location from a supply-demand perspective, demand being credit, fiscal spending, and then the supply side being constrained around the world and the underinvestment on that. And I'm curious to see, even if we dump a bunch of money at it, what kind of supply growth can we get? And I'm cautiously optimistic with the price going to some ridiculous level, and we'll see what the supply side does. So energy is looking fantastic from a long-term investment. If you try to put it on a yearly perspective, like what are my projections or stuff like that, I don't do a lot of projections, but I can give my opinions here. We could see a slowdown first and then a big move after. And the reason I say we could see a slowdown first is, and this has nothing to do with the oil markets directly, it deals with the financial markets. We've got an inverted yield curve. We are seeing yields start to come back. I think the Federal Reserve is going to lower interest rates, and that generally occurs when something bad in the market is already seen. So they're reacting to something that could potentially bring us back in the short term, 6 months to a year. We could see a pullback, which is possible in oil. Because I don't know what's behind the scenes, I can just see that the 2-year yield is dropping here recently, and the curve could uninvert, and that's generally when things can occur. So speaking in generalities, and I don't know the future, but if that curve drops and they lower rates, that's generally because of slowdown in the market or some problem in the market. You could see a pullback in oil, and then I think it's going to rip. It's going to rip. Now, if we don't get the pullback, I'm going to stay in it and just ride through whatever we get here. If we get the pullback, I'll buy more. If we don't get the pullback, I'm in it. I'll just ride this thing to which I think is going to be a lot higher levels. The ultimate levels that I think oil is going to get to in this bull market, I think it will get there late 2020s, early 2030s is probably when it will peak, is my guess. And I think we'll get somewhere around $300 to $500 a barrel. And that's kind of my estimate of where the thing will peak at. It's not going to be there forever. It's not going to be holding in a pattern for 20 years. It's going to spike up and then it'll come back down. And it'll probably come back down to a level that's $80 to $100 plus is my guess.
Yeah, I think a lot of people get caught up in the recency bias of basically the 70 to 90 range that's been stuck in for a while, and that's how it's always going to be. And I think there's a lot of people that basically don't have the upside potential kind of baked into what could happen. So I think that's
I'll make one more comment if I can.
Yeah.
So when inflation comes, it comes in waves or impulses. So think of it as like inflationary wave, and then it kind of dies down, and then it comes in another impulse, inflationary wave, and then it kind of dives down. I think that's what we're going to see. So you're going to get these periods where there's calm periods where you get this huge surge, and then it kind of consolidates. We're at the end. I think we're going to be entering towards an end of a consolidation. So we're coming towards the end. Sometimes at those ends, they do a fake wash sale at the end, and then it rips. I have a name for it. I call it the slingshot cheetah, where it pulls back. Everybody gets on the wrong side, and then it slingshots in the other direction. So at the end of these consolidations, that is possible, that we get this washout sale. And that's what I'm talking about, the pullback before the big move.
Yeah, one of the things I want to pull on there before we move to natural gas, you'd mentioned demand destruction, and I've seen a couple people. It's like, oh, oil's gonna get to 100, demand destruction, recession, like sky's falling. But I think if you look at where oil's been over the past, call it 15 years, like I don't really think demand destruction is at $100 a barrel anymore. It's probably a bit higher in my opinion, but I'd be curious to hear your thoughts on that.
Oh, I totally agree. I totally agree. It's not going to be at 80, 90, $100. I think we'll get true demand destruction at like $200 to $300 a barrel, where things are really going to start to pull back. So I think when I talk about that peak or that big move up, that's where you're going to get big demand destruction.
Yeah.
It's going to be somewhere, and it always spikes more than what it needs to, because people are going to all jump on the train all at the same time. So that's what I mean by a spike between like $300 and $500, because you'll get demand destruction. Then we'll go into some recession. It'll be, quote, the great financial crisis again. It'll be right before that.
Yeah, basically 100 years to the date of Great Depression, all that stuff, give or take.
Mm-hmm.
But as far as natural gas, like I've looked into it. Like I agree with some of the stuff you said about it being cheap. I haven't found any companies that I really like or I find like attractive enough or anything that like jumps off the page as, oh, that's the one to buy. So I'd be curious to hear your thoughts on natural gas as far as the commodity, but and then maybe if you could speak in generalities about what you kind of look for as far as the equities to play in natural gas.
Yeah, so the setup in nat gas, I think that we're on the low side right now. We're cheap. You can tell it's cheap when comparing it relative to all the other assets. And it's basically taking over coal in America and probably in other areas in the world as well. So it's replacing coal power plants with natural gas power plants. They run all this, all the renewables to a hub, basically. And then that hub has a natural gas plant there, and then they redistribute it. So there's like a converter there and stuff like that. So nat gas being as cheap as it is, I mean, everyone's just going to burn natural gas if they can because it's so cheap on a relative basis. We have adopted a lot of natural gas into our grid for electricity generation. We also have the weather aspect of heating homes and stuff like that. So it goes up and down and cycles up and down based off of the weather, heating demand, and then now also cooling demand. It is also subjected to a swing producer. So when renewables are not taking up the slack, they are producing electricity with natural gas. When wind is not being generated and or solar power is not being generated. So what we have in natural gas is like an amplified weather play where we've got all of these weather factors that could stack up in either direction, mostly in the positive direction for oil or for natural gas to go higher. And we're sitting at this really low location. We're at this low location because of 2 warm winters, and those 2 more winters and no real, I'll say, devastations to production. We're kind of just sitting at this low level. So I see it as a great way to put some money into it, invest in it, and we'll talk about maybe equities too, but invest in it and just sit in it and wait until something occurs. We're at a I think there's a lot of asymmetry there, big upside potential, small downside risk, and we're just waiting for an event or something to occur. The event would be a hurricane that wipes out a bunch of production. An event could be a cold winter or two. An event could be something occurs and damages the capacity of solar and wind, which then requires us to generate more electricity from natural gas. So I think there's a lot of things that could happen that could drive prices way higher than where we are today. And I'm just using it as an area to kind of sit in because it's so cheap. And that's kind of like all my plays. Like I look at all the symmetry, big upside potential, small downside risk. I scan the whole market. Where's the opportunities at? Why are they cheap? And what can make them expensive in turn? Natural gas, I think, is subjected to a lot of things that are outside of the control of humans, weather related and all that. And I think if things get on the wrong side for weather, that prices could go up, I mean, way higher than where we are today. And I don't know if there's any other commodity outside of maybe the setup in uranium, but there's not many commodities that are like this setup because we mainly have a lot of control over a lot of it. This is kind of out of the control to some degree, the weather I'm speaking about. So nat gas, I think, is an incredible opportunity for investment. Now, to translate that into investments, I know that the natural gas equities haven't pulled back as much, but there are still some equities that are out there that you could invest in natural gas that have a ton of growth. Up in Canada, there's natural gas companies that could have a ton of growth. There's also Canadian oil sands is basically a conversion of natural gas to liquid fuels, which is oil. I think that's also going to grow dramatically as well. So there's a lot of demand for natural gas coming, either from liquefied natural gas plants and terminals being built in Canada and America, with electricity generation, and with oil sands growth. That's all your demand kind of for natural gas. You can play it with these small caps that really haven't moved all that much. They're higher cost producers, and I think there's still a lot of growth in those. With the LNG terminals coming up in America and Canada and the growth of those terminals on the demand side, I think that it's going to be hard to balance supply and demand and all the weather. So something's gonna break and push these things to push the natural gas price to probably over $10 a million cubic foot at some point, or MMBT, I should say. So that's kind of my view on nat gas, and I think it's gonna take over electricity generation. And then you have all the demand for AI too in the data centers. It's like I don't even think the power or the transmission exists for all this demand. So yeah. I think the choke points, transmission of power and also power generation, which is going to be generated from natural gas.
Yeah, I think it's interesting because you see, like you said, in the next, call it 3 to 5 years, AI, more LNG, all these different things, and it's kind of all happening at once. And like, I don't think we're still looking at like a 2 or 3 handle when that happens. So I think at least for me, yeah. At least for me, like one of the things that's sort of tied to natural gas is thermal coal. And so I have some exposure there by way of Peabody. But I'd be curious to hear your thoughts on coal, because everyone thinks, oh, it's a dying industry and terrible place to invest. But I think it's going to be a fantastic place to hide from basically broader markets over the next 5 years with the valuations and the capital returns. And you kind of get these tobacco style capital returns story over the next, call it 5-10 years. So I'd be curious to hear your thoughts on maybe thermal versus met, and maybe what you think is more attractive, but what your thoughts are there.
Yeah. So I'll give my opinion. So number one, in 2020, I had the option to buy some of these at the bottom, and I blew it on coal. I went more natural gas. Coal has performed very well. And what I did is I know my brother works in the industry of power generation. He said, hey, we're taking out all these coal plants. We're replacing them all with natural gas. So, I went with the natural gas route. But I saw the signs in specifically the company that you mentioned there, Peabody. It had an inverted shoulder head, shoulder bottom. And I had an opportunity to snag it at $4, but I missed that opportunity. I think coal is going to be a fantastic opportunity to invest in. I think there's still demand growth. I think we're going to squeeze the crap out of natural gas. I think we're going to squeeze it out of coal. And then they're just going to say, screw it, burn whatever we can. Just generate the electricity. That's what I think will occur. And that's what we've seen and demonstrated in Germany and all these other areas. You could even make a more compelling case for natural gas and coal than you could for uranium. Because the companies make a bunch of money. They've got infrastructure in place. They know how to pump these things, make a bunch of money. Uranium and some of those companies, they're struggling to do anything in terms of making money, I should say. So that is what draws me to coal, is because they're making a lot of money, and it gets my attention. I think that they can continue to make more money. I think when the squeeze comes with these AI data centers and all that, I think it's going to squeeze nat gas. I think it's going to squeeze coal. It's going to squeeze electricity. I think thermal coal is good. I think met coal is good. I think they're both good. Met coal is going to get squeezed as well, because we're going to try to build this future with a bunch of electricity, and steel is, met coal and steel, and making, iron ore, steel, all this stuff coming together. It's like, man, this is going to be a huge opportunity to invest in thermal and or met coal. I think steel is a good spot to invest in. I think aluminum is a good spot to invest in, because everything, when this world gets short in energy and everybody wants a bunch more energy, and AI, I'll just talk about AI real quick. Artificial intelligence doesn't create something from nothing. It's not a god or anything like that. What it does is it takes an existing thing and then makes it more efficient. That's all technology does. Technology basically is a play on efficiency, and efficiency will just drive more demand. And as you get more efficient, you can convert this commodity into a design or a usable product. And you get better at doing that conversion. It's going to say, feed me a bunch more commodities, feed me more energy, feed me more commodities. And what I envision, and what I think is going to occur, is the wealth is going to have to transfer back. All the wealth in the world won't necessarily be in the conversion of it. I mean, it still will be, but there'll be wealth in the conversion, and there'll be a ton of wealth in the commodities itself. So when AI figures out ways to convert these commodities into usable products, everybody's going to want it. And then I think they're just going to shorten the lead times to do it. So it's going to say, feed me energy, feed me more commodities. So when I look at all like the setup, you're going to squeeze energy, and everything energy related is going to go way up. So that's one of my themes, investment themes, is around energy. And everything that touches energy, I think, will be a good play. And steel is, you're investing in mining of the commodities with steel, and also the transmission of energy. So that's why I have aluminum, steel, all these other things that I look at. So yeah, I think both metallurgical coal and I think thermal is going to do very well.
Yeah, I think like you're saying there with Jevons paradox, like it's not just some sunset industry. I think, as far as some of these things where, like, and the other thing I think that's maybe the most interesting part is that's basically capital constraints. So you're not going to see, I think, new supply coming online until like we get like a 5-year period where it becomes obvious, or just like basically these companies have so much cash they can go out and self-finance basically the growth. So
I'll make another comment here too. This restriction of energy could also impact technology in a negative way, because money's going to go wherever the problems are at. It's going to go to solve different problems. And if all the problems are in energy, I think that's where the money's going to flow. And if someone says, why, let's look, everyone thinks, I think this is what everyone thinks. Everyone thinks that we can just grow these NVIDIA chips and everything exponentially. But what if energy actually stops it? Like, what if NVIDIA is like, we can't sell any more chips because we don't have the power to power these things? Like, I think that could be a potential possibility if they, keep building all this stuff and they just want to continue to eat up the world's capacity of power, specifically electricity. And I know there's a lot of people that are on the uranium nuclear bandwagon, and I am too. I just don't know how that's going to work in the next 10 years. Like,
yeah,
I don't see that transition.
The other thing too is I was, and don't quote me on this, but someone was saying that one of the NVIDIA chips takes as much energy as like what it takes for an average house.
Yep.
And it's like, that's not going to scale. People talk about getting more efficient, all that, but I think you're right that the bottleneck is going to be like power generation, the actual commodities, and that's generally a good place to invest is in some of these bottlenecks. So
yeah, money's going to flood to it. That's my guess.
I think another place money's going to flood is going to be the precious metals. I've been doing some buying there lately. I try to avoid the miners in that area, but I basically couldn't help myself on one of them, a couple of them. But maybe if we would start with gold and silver, get your thoughts on the actual commodity, where that might be headed, and then some of your thoughts on the miners. I know it's like I think we're basically early innings of a massive bull market for precious metals. So I'd be curious to hear you have to think about that.
Yeah. So historically, gold and silver do very well when you get these big inflationary impulse waves that I talked about earlier. Oil and energy does very well on the impulse up. And then when it comes back down, that's when gold and silver. So they kind of like, they like go up. So energy goes up. And then when it pauses, gold goes up. And then when that pauses, they switch off back and forth. With the yield curve where it's located, the 2-year and the 10-year, what happens is they get inverted. And through history, whenever the yield curve uninverts, when it comes back down, that's when gold takes off. So gold is highly sensitive to the slowing of the market. Slowing of inflation is what I'll call it. So I think we're in a location where gold and silver are just going to rip. And we're like right there. We're in that move. So with the location of where gold and silver mining companies are located, they're very cheap in relationship to gold. And they haven't been this cheap, I don't think, forever. So if it were me, what I would do is I would gain some exposure because of the symmetry being so big to the upside in the gold and silver mining companies. I would throw my preconceived notions or ideas on it and just say, you know what, I'm gonna put sidebar that, I'm gonna have some exposure. That's what I would do. And it's good that everyone is still negative on it. And I know why they're negative. They're negative because they don't see the correlation of the miners to the physical price of gold. They didn't see it last bull market, which was in a declining interest rate environment. And it underperformed, a lot of them underperformed. But in the 1970s, if you go back and you look at some of the returns of gold and silver mining companies, you're going to be absolutely floored. You're going to be like, wait, some of the average, some of the juniors, they went ballistic. And when I mean ballistic, I'm not talking like 10 times the money or 20 times. I'm talking like add zeros on the back. like it was like, wow, this is multi-hundred, times returns. And what I'm telling you is when everyone's negative on it, that's the time you want to buy what you can when it's down there. And it's very tough to do. It's tough to separate you or whoever from the herd and that herd thinking. So what I'm saying is the returns are so big and the symmetry is so large that just having some percent, whatever it is, whatever you decide, to do, 3%, 5%, 10%, whatever it is of the portfolio, that's going to carry it, and it's not going to matter if you only hold that amount. Like, it will still be a life-changing amount. So the symmetry is so big, that's what I would focus on. It's like I would look at those gold and silver mining companies. And again, I don't know if that's going to be the outcome. But because the symmetry is so big, I have to have something there.
Yeah. I think there are a couple of miners I've looked at in the gold and silver space, a couple of royalty plays, but definitely something where, like you said, I think in the back half of this year into 2025, it's going to be a pretty good place to be invested. But the space I'm even more bullish on is platinum and the PGM miners. And that's, I think, one of those things. Like, I was talking to one of my buddies, and he was basically showing me a chart of platinum to silver, and it basically goes back all the way to 1980 with the Hunt Brothers silver squeeze, and we're kind of in that same ballpark now with platinum. So,
yeah, so platinum is really cheap. It's cheap against all the other metals on a ratio perspective. There's been times in history where other metals were cheap against all the other metals. Rhodium in 2016, palladium in 2009, 2005. Silver, I would say 2000-ish time frame was really cheap against all the metals. Every time you're cheap against all the metals and you purchased that metal that was cheap, it's worked out very well if you had a long enough time frame to hold it. Again, a lot of this comes down to taking a long enough time frame. And your time frame needs to stretch in a decade time frame or something like that. Not so much in weeks and months. And I know everybody wants to try to get rich, really fast, but
at least 3 to 5 years. At least 3 to 5 years.
Yeah, you're going to have to take on exorbitant amounts of risks, and usually most of those people lose it all. That's been the case with a lot of traders. So platinum and the setup in platinum, yeah, it looks absolutely fantastic. It's been cheap for a decently long period of time. The substitution is going to occur between platinum substituting palladium and catalytic converters and other things. So it's all set up. It's all there. Also, another cool thing about the PGM mining companies is that they're basically monopolies. So they're so concentrated. I think this is one of the most concentrated areas for mining, where a few producers produce something like 60 to 80% of the world's platinum. So you're talking like a handful. When I mean a handful, I'm talking like 3. So it's a monopoly, and you can put some money in there. Yes, there's jurisdictional risk and all that stuff. But again, the symmetry is so large that I have to have some money in it to gain that exposure to it. So I think platinum's going to, if I were to make a guess, I think we could get one last scare in platinum. And what I mean by this is, if that yield curve uninverts, gold and silver might rip, and silver could maybe still outperform platinum in the very short term with one last like fake breakout to the bottom, and then platinum just goes. And again, I know a lot of people want certainty. In investing, you don't get certainty. You get probabilities and likelihoods, and you're trying to guess what people are going to do from a psychological perspective. That's why you've got technical analysis and all these chart patterns. It's all an extension of psychology of the herd. So what I'm trying to tell you guys is the possibility. You got to get ready for these things, where if it falls and breaks down, it's not that it's breaking down and going to stay down there. You're already below the cost curves. The big mining companies, the platinum group metal mining companies, have already pulled back on production. It's already too cheap. It's just how greedy do you want to get? If you get that pullback, you've got another opportunity to really just load up before it moves to the upside. So platinum's in a great location. I think if you're playing the physical metals, go ballistic if this thing does get a little bit of a pullback. And yeah, I think it's a great setup.
Yeah, I think it is one of those things. I think when the precious metals bull market like really gets going, wouldn't be surprised to see platinum catch up to gold. But I mean, there's a reason. There's a reason.
Higher than gold.
Yeah, there's a reason the platinum tier on credit cards is above the gold tier. So
I'll give my estimates if people want to know estimates. I know they always want estimates. So I think that whenever we peak, platinum will be 2 times the price of gold. Just looking history, and a lot of people don't know this. If you go back and you look at Weimar Germany and you do a gold or a platinum to gold ratio chart, it's actually squeezing from the 1800s, like late 1800s, early 1900s. It's squeezing from that ratio all the way to the tip where we are today. So there's your opportunity. What that means now is if you buy 1 ounce of platinum, the potential, if we do break this big, I'll call it falling wedge consolidation, and we go back to some 3, 4, 5 times the price of gold, that means every ounce you buy today, and I'm just going to say, let's say it's 0.5 for easy math, and we go to 3, that's 6 times or 6 ounces of gold that you can swap it for in the future. It's like, wow, that's incredible if it does that again. Obviously, I don't know the future, but if it does something like that, then yeah, I'm going to own a lot of gold.
Yeah, there's some parallels between Weimar and today here in the U.S. So I wouldn't be surprised if we get some interesting things going on as far as monetary maybe not hyperinflation, but just
inflation.
Hard assets. I think are going to be a good place to be. I think is the short version. So I guess one last question I had for you is, outside of the commodity space, are there any other sectors you find interesting or any other opportunities you're looking at that are not kind of tied to resources or tied to hard assets, or is it kind of just depends on the situation?
Yeah. So what I think is going to occur here shortly is that if they lower rates, we're going to see a weakening of the dollar. When the dollar weakens, emerging markets are going to rip. And you can look at different emerging markets like Brazil, Canada. Look at their currencies as well. Their currencies are all kind of like squeezing into a corner of falling wedges. They've broken out, and they've kind of just been moving sideways. I think they've been moving sideways because of how aggressive we've raised rates over the past few years. And when those rates come back down, I think it's game on. Like emerging markets, you can look at individual companies, even I'm sure Chinese companies could come out of I'm not like pro-China by anything like that. There's some risks there, obviously, but they just went through a large real estate crash. Their demographic fell off a cliff, and there could be some opportunities in technology stocks there over the next year or two, or right now. So there's some opportunities there. India would be a great opportunity if the dollar weakens. They have a growing population. You could easily just throw darts at like Indian banks, probably make a bunch of money. That was an idea I had back in the last bull market. That's where you could potentially be based off of the growth, the demographic growth that India has coming into home buying and all that stuff. So I think emerging markets, I think Canada, I think all of those places when the dollar drops is going to be a good location.
Yeah. I guess as far as a couple other questions, as far as your approach, like how do you decide on position size? So I know a lot of people kind of have a very concentrated approach. I tend to be more concentrated. Other people basically spread out between 30, 40, 50 companies. And the quote is there's only two position sizes, too big or too small. But I think that's one of the things I've been starting to think about some more as far as my approach is trying to dial in like which investments I should size up at certain times or should be cutting back. So I'd be curious to hear your thoughts on that.
Yeah, so depending on where the investment is located and the undervaluation of that investment will determine your position size to some degree, because that is you're controlling your risk with your purchase price. Another thing that will determine it is the company itself. Are they diversified? Do they have multiple mines, or are they a single mine operator in a single country? If you're a single mine operator with the risk of one country, I mean, that's a lot of risk. You could concentrate a lot of money in a single company that has a lot of risk. You don't have that type of risk in an energy service company that can just move around. So I think the mining companies have risks that are outside of the company's control that you also have to factor into play when you invest in some of these mining companies. So your position size should take that into account. It should take into account where are you buying this asset, how cheap is it, what risks are you facing that are out of the control of the company, and then what risks do the company have as well. So all of those things stack up. So I'll give an example of when to maybe oversize and take a risk. You go into this uninversion of the yield curve that could potentially be coming. Everyone gets fearful and they sell absolutely everything. Indiscriminate selling, just everything drops like a rock. And then we get a big wick at the bottom or some sort of bottoming pattern that starts to show up. You see a company that is like a small mid cap. It's got infrastructure in place, and you've just blown everything out to the downside. Your ratios, like gold to oil, oil to financial assets, they're at like unheard of levels, say like 2020. They're above 30 to 1. They're 50 to 1, 100 to 1, like just ridiculously cheap. That's when you go big. That's when you go big. You don't go big when your ratio is not cheap. Things have run many hundreds of percents or 1,000%. Like NVIDIA is just an absolute horrible spot to be buying here. Absolute horrible. So if you want to be a good investor, in my opinion, which is it's very difficult to do this to everyone, you got to be opposite. And you got to be able to think of ways where you can do things that other people are going to tell you that you're stupid. And then that's when you go max full stupid, so to speak.
Got to have a contrarian approach.
Well, I mean, so when I was getting a lot of crap even on YouTube like in the comments section, Kathy Wood thinks that it's not going to go up. Oil is going to stay at like 25 or whatever the heck she was saying. And I'm over here saying and thinking in my mind, we're going 250 plus. Like that's what I was thinking at the bottom. And that's kind of the mindset that you have to have. You have to be able to see the future before the future materializes. Like you have like this vision, like, oh, this is going to throw us to the downside so bad that we're going to cut back production. They printed all this money too. And I'm like, oh, this is like an easy bet. And you still get like nervous though, because if I'm going to, dump a bunch of money at something that is down and could potentially go bankrupt, that's your risk. But that if it goes out, like this thing's going to be a rocket ship out of here if they don't go bankrupt. And that's where you make all the money though, because if the potential possibility of bankruptcy is what gets you down to pennies on the dollar on the selling pressure down move. So to get you back up, they have the infrastructure in place. Now it's just a play on the commodity itself. So that's where you got to get a lot of people, they don't want to buy down there because all their friends are, they're buying bonds when they should be buying equities or whatever else. So you have to do opposite of everyone else. You have to take on the risk if you are going to take the risk, and then you're going to be buying assets, pennies at the dollar. If you buy at that location, you don't want to put everything in position size all in one company. You might want to position size it across because the symmetry is so big where even if you lose a position or two, you still just rip because you can get 20, 30, 40, 100 times your money. If you can hold it and you've got the duration, like the mindset to hold it through a lot of these pullbacks to ride it all the way on up. And that's basically what I've been studying is it's how does Buffett and a lot of these other guys, how they make their money, how did they get so rich? And that's how they got rich. They bought stuff out of favor. The symmetry is what carried everything. And they didn't make 100% good investments. They made a few investments with the symmetry being just absolutely ridiculous that carried them to the upside. So that's basically what I did. I just didn't know I was doing it the same way that maybe Buffett and some of these other guys were doing it when I did it in 2020. And that's where I made a bunch of my money. It's all from symmetry and doing it in a contrarian way. So your position size should be equivalent to where you're buying it, basically how contrarian you are at that time, what the chart patterns look like at that time, what the ratios look like. Is it a cheap asset? And if everything checks the box, like yes, the yield curve's like uninverted, like we just went through a crash, like that's the time to go ultra long. Right now, in my opinion, I think it's time to go ultra long in gold and silver because we're in the opposite part of that cycle. And the opposite part, when the yield curve uninverts, like you've got gold and silver mining companies that are cheap to gold. You've got the yield curve that's inverted, I think is going to uninvert. Like that's all positive for gold and silver. So we're like in the opposite camp that we were in 2020. Like we're just in the opposite portion of the cycle. And I think gold and silver has all the tailwinds now.
Yeah.
So that's kind of, and platinum and all those. So I think, huge opportunities there.
Yeah, it's interesting when you see some of the stuff where it's like when you start to like fast forward a couple of years and basically guess what things could look like for a commodity or a certain sector, and it's like, okay, this is definitely one I should size up or certain, basically add to this position or this sector. But when you see something like that, do you ever buy calls or use options where it's like, okay, I think 2 years is enough time, or do you basically stay away because of the expiration and all that? Because I occasionally will throw a couple $100 at calls or basically just very small compared to what I'd buy in the shares, but I'd like to have that kicker sometimes. So
I think if you're at a bottom, it is worth doing and you want to take that risk. Yeah, the symmetry is so big at that time. If you can do an option and get it right, it could be a life-changing move. If I had done that on one of my investments and how fast it appreciated, I don't even want to know the math. I didn't do the math, but I'm pretty sure if I put a couple grand into it, it would probably be worth over $1 million in like a year or two. But there's a very small window where you should be doing that. Like it is very small, and you're going to have to do it because you don't know how the response is going to be from the markets. You don't know if it's going to be like a V bottom or if it's going to grind out sideways at the bottom. So I think small amounts of money in very short periods of time, if you're going to do like a call option or something, you could do that.
Yeah, that's where I basically think like this, like keeping it small is kind of the smart way to play it, because if you go too big on that, then it's just like you're basically bleeding out over time with all the stuff there. So,
well, you're gambling at that. It's
yeah.
part of the gamble. And if you do it with all your money and you're doing it all the time, it's just a matter of time before you go broke.
Yeah,
like that's the problem. Writing call options or writing options would probably be a better way of maybe generating income for a portfolio than it would be to actually buying options. But there are times in history where you could do options, and I think you can make a lot of money if you can get the bottom right. But I wouldn't do it with a lot of money. I would do it with like a small amount, percentage-wise of the portfolio.
Yeah.
Not even 1%.
Yeah. No, I keep it very small, but there's certain things where I almost can't help myself, have to throw a couple bucks at it. But is there any other sectors you think would be worth covering, or any other topics you want to hit on before we kind of wrap up?
Yeah. So what I've found, doing all my research and stuff and reading others and successful investors, I think I can narrow it down to like a few things on like one hand. Position sizing is how to position size. I think that's a very important thing as an investor, figuring out how to position size. Asymmetry is another big one. Having that huge asymmetry is another big deal. And then your time frame, like holding long enough for it to develop. And what I have found is you have to basically adopt strategies that other people don't adopt. So you need to have a longer time frame than everyone else. You need to buy when everyone else isn't. And then you want the symmetry. So that's kind of what I found to be like the special mix. Looking at those things that qualify right now, I think steel looks pretty good. Steel, iron ore. I know it sounds boring. I know it sounds really stupid, but you know what? Some of these companies went up 100x in 5 years. 100x. Now people are going to get interested, right? Oh, 100x, that's a lot of money. So some of these steel companies, they went up 50x plus on a lot of them in that last bull market when the dollar dropped. When the dollar drops, it generally starts with rates dropping first. And when those rates drop, they might get pulled down to the downside a little bit. Everybody gets scared. And when everybody gets scared, there's your opportunity. You got to pounce on it if we do get that opportunity that is coming up. And steel is one of those opportunities. I think could be a huge winner. So steel, I think looks good. Fertilizers. There's there's some companies that make like ammonium, and ammonium is a fuel. And I think it's going to be a big portion of a fuel in the future that people don't talk about at all. So I play that as well as ammonium. And last bull market, those went up dramatically, 50 times plus, depending on what you were looking at. So I think there's big opportunity there. I would say those two are kind of overlooked at the moment. I know we didn't really talk much about copper. I think copper's good too. I just don't know a really great way to play copper.
That's kind of what I'm hearing from a lot of people that are in the same boat as me, where it's like, you look at copper, it's like, we can all see over 5-10 years it's going higher, but then you look at the options and it's just like,
I bought one company back, and it was a little while back, like it was 8 years ago or something, or 7 years ago. I've been holding it ever since, and that's gone way up, but I don't know of anything else. That's just a big company that I purchased. It wasn't anything small. Here's another thing for retail investors. If you want to make money like reliably, stop buying all these speculative companies. Like, a lot of them are just a waste of time. So yes, they're trying to sell you things on YouTube and they've got ads, but there's reason they have ads. It's because they're trying to take your money. So I would be real careful of going into too much of these speculative companies. I've really just focused on cash companies almost exclusively now. Dividend paying companies, I know people kind of write those off. A dividend, it's not going to be a fast enough growth, for me. That's what people are going to say. I'm just going to say, 20x is 20x, whether it pays a dividend or not. Like it's good. And if part of your returns are from dividends, so be it.
Yeah.
So,
the funny thing is that people will overlook certain sectors and just stay out of it just for kind of reasons I find unintelligent, but that's the way investing works these days. Everyone wants to chase a shiny object. So, the closing question I came up with is, what book do you think I should add to my reading list? Can be finance, investments, history, somewhere in between, whatever you want. So, yeah.
I mean, I like One Up on Wall Street by Peter Lynch, Reminiscences of a Stock Operator by Edwin LaFleur, or however you say his last name. Those are two that I read, but in all honesty, I don't think you're going to learn enough to become a good investor by just reading books. I know reading's great, but I think you want to read about the traits and the setups that a lot of these investors have. And then you're going to have to figure out how to connect what they're doing. And there's certain aspects that you're going to have to develop as a person that you can't get through a book. So it's almost like you need a mentor or you need someone to help you through it. So you kind of know that you're investing is a lot about going against your feelings. So you can read a book and it's oh, I know what to do. And then you go and you actually do it. And, Mike Tyson has a quote. I think everyone has a plan until they get punched in the face. And it's that's what investing is. Everyone has a plan. Oh, I'm going to buy it down here. I'm going to ride it all the way up. And then all of a sudden they're getting punched in the face by the market. Your account went down 20%, 30%. What do I do? Am I right? Am I wrong? They focus too much on the short-term market movements, and they convince themselves that the market and the price movements are right and I am wrong. And then they sell into that fear. I don't know how a book can teach you that. If you have someone there that's kind of like a mentor helping you out, you could say look, I feel like crap. Is this a good time to sell? And then someone else says, no. This, everything's good. This is what you need to focus on. You need to focus on the longer term. You need to focus on, still cheap. We still have tailwinds. This is just a short-term correction. And that's where I don't know how you can get that from reading a book or whatever. I mean, you can look at certain things and I've read some books. I've read, what's his name? Ken Fisher, he wrote a couple books. Peter Schiff, he wrote books. I read all these books, and I'm I didn't become a good investor from those books, even though they gave you presented data. They went through all these things. It's almost like you have to jump into the matrix of investing to some degree. You can't be 1 foot in, 1 foot out. You got to kind of jump in the matrix and just be all right, I'm going to really figure this out. And then you have to control your emotions. And I think for some people and personality traits, that might be difficult to do, and you really need help from someone else. So, I mean, that's what I'll say. I would also say that most people don't hold long enough. Their holding period is way too short.
Yeah, I agree. I think that's where, I don't know if you listen to the Founders podcast, but I find the biographies of entrepreneurs and some of these people, historical figures, pretty interesting. And that's, like you said, that might be more useful than a book that's specifically focused on the nuts and bolts of investing, because you get the personality traits and what makes them tick and all those things that are maybe a little bit harder to quantify. So before we wrap up, why don't you give the viewers one last plug for your website, YouTube, anything else you want to talk about? So
I've got a YouTube channel. It's Finding Value Finance, if you want to search that up. And if you want to join the website that I run or our community that we have, it's basically a bunch of investors. We're trying to navigate the commodity bull market that we're in. we're looking for investment opportunities, and everyone picks and chooses how they want to basically do their portfolio. And I just present opportunities, and I let you guys know it's like, hey, look, this is a high risk, high reward company. This is a really good risk reward company that's making money. And then, there's other ones that maybe they're not as volatile, but people want to get into them because of the dividend yield or something like that. So a bunch of different approaches that we have on the website. We have a Discord channel and all that stuff too that we converse back and forth with. So that's basically what I've got.
Awesome. Well, I really appreciate you taking the time and coming on. I think we'll be wrapping up there. So thanks for stopping by, and we'll see you next time.